Next slide. No problems for chapter 15.
I love the blank slides.
Yeah! Venture capital is private equity, private financing for new high-risk businesses in exchange for stock. Individual investors and venture capital firms meet together in a perfect harmony, in a perfect world.
It's all about venture capitalists, man. You gotta love venture capitalists and angel investors.
I would love to be one. After I start my own business and make millions of dollars, invest in others, that would be wonderful. Usually involves active participation by the venture capitalist. The ultimate goal is to take the company public, and the venture capitalist will benefit from the capital raised in the initial public offering. Oftentimes, venture capital is hard to find and very expensive. Issue methods. Public issue. Registration with the SEC is required to issue stock. A general cash offer is offered to the general public, or a rights offer is only offered to current shareholders. IPO is an initial public offering, an unseasoned new issue of stock. SEO is a seasoned equity offering stock from an established company. A private issue is sold to less than 35 investors, and an SEC registration is not required. Underwriting services formulate the method to issue securities. They price the securities, they sell the securities, and they have price stabilization by the lead underwriter in the aftermarket. Isn't that neat? Okay, so the lead underwriter will stabilize the price of the stock in the aftermarket. So after the initial offering, is that what it's saying? Syndicate is a group of investment bankers that...
They always ask you, what's the name of the group of investment bankers behind buying and selling securities?
Syndicate.
And it's always syndicate. Your mama, syndicate.
My mom is a group of bankers?
No. And the spread is the same thing that we did with the 30 seconds, like the 145.12. It's the difference between what the syndicate pays the company and what it sells for in the market. The spread is the same thing.
Awesome. Ooh, another blank slide. Short-term financial policy. See, look, we're almost done. We've just been breezing through these. Just got slides now. Flexible policy means there are large amounts of cash and marketable securities, large amounts of inventory. Liberal credit policies, large accounts receivable, relatively low levels of short-term liabilities, means the company is highly liquid. Okay, so it has a lot of short-term assets. And a restrictive financial policy means you have low cash and marketable security balances, low inventory levels, little or no credit sales, and relatively high levels of short-term liabilities. So like this would be like Walmart, I guess. No, they would have a large amount of inventory.
Yeah, shit.
Yeah. So this would be more like Walmart. So I know they also have credit cards. So, anyway. Carrying versus shortage costs.
Carrying costs is like storing it, and if it needs like refrigeration and stuff like that.
And then, so opportunity costs of owning current assets versus long-term assets that pay higher returns. Covered that well, man. Boom. Shortage costs. The cost of ordering additional inventory or transferring cash is an order cost, and the cost of lost sales due to lack of inventory, including lost customers, is a stock-out cost. Cash budget is a primary tool in short-term financial planning. Identify short-term needs and opportunities. Identify when short-term financing may be required. You identify sales and cash collections. Identify various cash outflows. Subtract outflows from inflows and determine investing and financing needs.
Get it?
Boom! Reasons for holding cash.
From your favorite economist, John Maynard Keynes.
Speculative motive. Take advantage of unexpected opportunities. Precautionary motive in case of emergencies. Transaction motive to pay day-to-day bills. Trade-off. Opportunity cost of holding cash versus the transaction cost of converting marketable securities to cash. Okay, so what this is saying, I think, is you have a cash reserve so that you can take advantage of opportunities, so that you can take care of emergencies, so you can take care of bills.
Yeah.
But
you need to be fairly liquid.
right.
but there's a big opportunity cost between holding cash versus having your assets in,
A money market or something like that.
yeah, so that you can at least be earning some return. Understanding float, the difference between the cash balance recorded in the cash account and the cash balance recorded at the bank.
That's pretty much exactly what we did today in personal finance, right? Kind of like
Yeah.
the checks. It's similar, but that was a personal level. This is on a large scale corporate level.
Right. And it's very, very much the same idea. Like this is disbursement float is generated when a firm writes checks.
Yeah.
Available balance at the bank minus the book balance is greater than 0.
So that's the disbursement flow, okay. And the collection flow is the opposite.
Checks received increase the book balance before the bank credit hits the account. The available balance at the bank minus the book balance is less than 0. Net float equals disbursement float plus collection float. Okay, so I'm a bit confused by this. Okay, so the firm writes a check, and the bank doesn't take it out of the account until maybe like 3 days later.
Yeah.
So in effect, they have that money to still use until the bank takes it away. Collection float, the firm takes the check, they put it in their account and immediately get the funds, but their books are increased before the bank what does it mean? The bank credits the account
It's opposite.
for it.
So if a bank credits the account, it's pretty much increasing your bank account. It doesn't matter. All you have to know is the collection float, the balance available in the bank is less the book balance is, you know what that means.
Okay, so the balance available at the bank minus the book balance. Okay,
So basically for the disbursement float, if the balance available at the bank is greater than the book balance, it's a disbursement float. And the opposite is true for the collection float.
Okay. So, like, say, okay, I need to put this in numbers. Okay, say you have $100,000 at the bank and $100,000 on your books. So you write a check, and now the amount available at the bank is greater than the amount that you have on your books. But, on the other hand, if you receive a check, then you put it on your books immediately.
Yeah.
So, then in that case, your book balance
Is greater
than the amount that you have in the bank.
That's right.
Okay, awesome. Credit.
And not just what I just said. I just said that. What's a disbursement float? So when the balance at the bank is greater than the balance at the books.
Disbursement float. Balance at the bank is greater than the balance in the books. Okay. Disbursement float balance at the bank is greater than the balance.
And you don't need to even think about it. What's a collection float? The
Collection
opposite.
float.
The opposite.
Opposite. So balance at the
Books is greater than the bank.
balance at the bank.
Got it.
Okay. Collection float balance on the books is greater than the balance on the
Because
bank.
you're collecting. It has to be greater at the bank. It has to be greater.
So greater
Sorry.
on the books. Said it backwards.
I did say it right.
Okay. You're collecting the money, so you get it immediately. You put it on the books.
It's a collection.
So, yes, it's a collection. So you get. So the balance in your books is greater than the balance of the bank.
What does the MPV have?
The NPV has a percent,
Of course.
and the IRR does not have a P, so it does not have a
It
percent.
does not have a P. It does not have a P. Let's go. Let's do it. Let's get it.
Almost done. Look at that. Almost done. 10 more slides,
Boom.
and one of them is blank.
Oh, I love the blank one.
Credit management. Key issues. Granting credit increases sales,